Where do you think, or if you're speaking to someone who's on the fence now around buying a property, what are you thinking about here?
Well, it's interesting, like with investing, we always want to zoom out, right? If you just look at the last 10 or 15 years, it was hard to lose in property, right? If you bought an established house, like prices just kept rising. If you're investing in the stock market, it's all been about the tech sector and the S&P 500. And because of those two things, I think a lot of investors have forgotten that income and yield actually matters when you're making an investment decision. Because it's been so easy in those two sectors, it's been relatively easy just to go for capital growth. And you're getting so much growth, you don't care about the income or the rent or the yield.
We also heard from the broking team yesterday that some of the banks have actually started reducing interest rates on SMSF loans. Clearly, they're a little bit worried around the uptake on SMSF borrowing, so they've actually started reducing some of the interest rates on it, which historically, I suppose, the interest rate on a self-managed super fund loan would be at least probably 0.5 or 1%. What you're going to get on a standard property, so you're generally already paying over 7%. But I think all right, the Australian government has just ended negative gearing. The Reserve Bank has hiked interest rates 3 times this year, and your bank is sitting on $370 billion of your money, paying you almost nothing. These aren't 3 separate stories. They're one story about who wins and who loses in a higher rate Australia. And that's what we're going to be breaking down today on the Winners Playbook. We're going to be going into property first, talking what's changed, what it means in real numbers. Secondly, we'll be jumping into the banks, the structural threats to the sector that is propping up the ASX. And third, we're then going to be jumping into savings and what most Australians can do right now today that will matter most in 10 years' time. But before we rip into that, Puli, what's happening on your end, mate?
What's going on? Well, I banned myself from reading about the budget because I was getting too into the weeds there. So
Yep.
I think I've got enough knowledge about that.
Yep.
So just getting stuck into client work as we rip towards June 30.
Yeah, it's busy towards June 30. Lots happening from super contribution perspective. Obviously, accountants very busy doing their tax planning at the same time, and a lot of clients thinking about getting some more money into superannuation before 30 June. And it's good to know, or good to note for anyone that is listening, that certain funds do have different cutoff dates as well for superannuation. There are some funds that do allow you to contribute pretty much right up until 30 June, and providing the money then hits, you'll be able to claim it. But some funds, I think some of the industry funds actually cut off 2 weeks in advance of 30 June. So you do have to be a little bit careful if you are planning to make any contributions for the end of the financial year. And I was just having a conversation with the client before we hopped into the podcast around exactly this, because providing the money does hit before 30 June, the notice of intent it can be lodged any time thereafter before you lodge your tax return. So it's worthy to note that you don't actually have to lodge a notice of intent before 30 June. You can always do that after, but keynote, making sure the money does hit. Other than that, Billy, anything else for you?
No, that's it, mate. Let's get into it.
Well, let's dive into property, because we've been having a lot of conversations around property as of late, not just with clients, in my own life, with buyers agents that we work with at the same time. And, we've seen clearance rates actually, I believe, at their lowest point since about 2020. So that's looking at property selling at auction over the weekend, and that's hit its lowest rate since 2020. So since the budget announcements, obviously a bit of steam has come out of the property market, no doubt, and that's what we're going to be unpacking today. And I suppose where do we start there, Billy? So obviously interest rates have started going up. We know this. Negative gearing, what has been proposed is it's basically going to be wiped out. And the interesting thing is, I was chatting with one of our brokers just the other day around a real client scenario that they had. And the banks, even though it hasn't been legislated yet, these negative gearing changes essentially, the banks are already factoring that into their how they assess borrowing, basically. And they had one client who was going to be borrowing to buy an investment property. And because the banks were factoring in negative gearing to the equation, but now they're not, the borrowing capacity of that individual has dropped about 25%, which is pretty significant. And you can only think, not that it's the only lever that affects property prices and if they're growing or going backwards in value, but it is a significant one. If someone that could borrow $1 million yesterday can now only borrow $750,000 to buy a property, you got to think that's going to have an impact on property prices.
Yeah, it's massive. And I think that's actually one of the biggest drivers of property prices is availability of credit, like how much money you can actually get from the bank. Because most people, they're going to go, what's the most I can borrow? And they'll often borrow close to that amount.
Yep.
So if that suddenly gets reduced by 25%, that's going to have an immediate impact on demand and prices, I think.
Yeah, and we're seeing a bit on the upper end of town, I think. We're seeing a bit of pressure on that side of things.
Yeah, definitely. And that it sort of makes you think with these changes, property sub $1 million might go okay, but property worth more than $1 million, you don't have your first home buyer incentives. You now got reduced borrowing capacity for investors, no negative gearing. That's the area of the market, and higher interest rates. So that's definitely the part of the market that could be impacted pretty hard.
Yeah, and so the official cutoff was 7:30 on the 12th of May 2026, and then if you'd owned a property by that point, it's going to be grandfathered under the current rules and what was proposed. New builds will be still, you can get negative gearing. But that's, I suppose, kind of where we're sitting at this point in time. But this isn't the first time we've actually seen negative gearing abolished. Do you want to unpack a bit of a history lesson we've got here?
Yeah, so this happened back in 1985. The Hawke-Keating government got rid of negative gearing, then rents rose, and then they reinstated it 2 years later.
Sounds like they chickened out pretty quickly.
So I don't feel like that's going to happen the same way this time, because the federal Labor government has wanted to kill negative gearing for years. Now they've finally got what they want. I don't think they'll be in a rush to bring it back. And obviously the market's different now to what it was in the 80s.
Yeah.
But it certainly makes you think it's pretty likely we're going to see rents go up.
Yeah, which is then, it's going to hurt a lot of Australians at the exact same time, because again, I think the government said that they've forecasted a $10 a week rent rise for most people, which we know those numbers don't mean anything whatsoever.
It drives me nuts when people show treasury modelling, because it's all total BS. We do modelling for clients every week, right? And we know that with all the different variables involved, your modelling's not, it's only worth so much, because things are uncertain and unpredictable. And to say, rents will go up $10 a week, I mean, that's insane. Like, they're either going to go up dramatically or they're not.
Yeah, maybe a bit of ChatGPT modelling in there, you think? Maybe a little bit of AI thrown in among some of that. Yeah, I was actually looking for a little bit further into it, because it was actually before I was born, so I can talk from first-hand experience. Yeah, but looking back to 1985, and they were reinstated in 1987. So digging a little bit below the surface there. So in Sydney and Perth, rents basically skyrocketed at that point in time. But interestingly enough, Melbourne, Brisbane, and Adelaide were quite flat over that period. So it wasn't necessarily just the changes to negative gearing. I suppose there's two arguments to this, depending upon which side of the fence that you actually sit on. But there was also back to like supply and demand of the amount of actual housing that was available. Whereas, if you had Melbourne, Brisbane, and Adelaide at that point in time, it was rather flat. So that would lead me to believe there's probably a bit more supply around. Whereas then in the likes of Sydney and Perth, where it skyrocketed, there probably wasn't enough housing as it is, and that's what we are seeing in a lot of different states and territories around Australia.
I doubt vacancy rates were that low back then, because now they're low across the board, right? In all capital cities, we've got very, very low vacancy rates. So we've already got extremely tight supply-demand fundamentals. So the supply-demand thing isn't going to change. It'll probably get worse for rentals. So then it just comes back to households' ability to pay higher rents. That's probably the main thing.
Yeah,
it's all very well saying rents will go up. Well, if people literally can't afford to pay higher rents, then there's only so high they can go.
Yeah, it puts I suppose a lot of Australians in a pretty tricky situation. At this point in time, particularly if you're not seeing that wages growth as well, or you're not in a role where you maybe have a bit of way to sort of dictate what you're paid, because you get like bonuses or commissions and so on and so forth. If you're just in that average job, you're getting your 2 or 3% pay rises year on year, and then your rent goes up $100 a week or whatever it may be. I suppose what do you do?
Yeah, well, you can't win. Like these changes, they might help some first home buyers, but they'll hurt renters. You can't really have it both ways. Like in a market where supply is so tight, if you're going to help renters, you're going to hurt home buyers, or vice versa. Like, you're not going to get a win-win with that policy.
Have you seen any? I actually haven't been scaring the headlines too much at the moment, but have you seen any major calls around property pricing corrections? Because you usually start seeing some of the doomsdayers coming out at this point in time saying 20-30% correction. Because I remember that during COVID. I'm sure it was COVID where a few people come out and I think it was the CBA, even some of the banks were coming out talking about, 20-30% corrections in property prices. And then what happened? They went the other way. They actually went up, say 20 or 30% in a short period of time. Have you seen anyone getting out there and throwing any?
Yeah, like all the major institutions are doing what they usually do and just being really conservative. Like they're saying, there might be a 4% correction or whatever it might be. And then you've got doomsdayers saying 30-40%. They're probably the same people who have been making that call for the last 10 years. What will the truth be? Well, COVID's very different because following COVID, central banks slashed rates to nothing. So it comes back to that availability of credit we were talking about before. Right? People could borrow more money. Prices went up.
Yeah,
that's not happening this time.
Yeah.
So that's the difference. So in my view, we absolutely could see some price falls, probably bigger than we've ever seen, which isn't saying much because prices have never fallen more than like 10% in Australia in the last 40 or 50 years.
Yeah.
But yeah, 10% is definitely on the table, I think, especially for properties worth more than $1 million, where you just don't have that demand isn't going to be there for those houses.
Yeah, it's going to be interesting to see the variability amongst, like, there's different price brackets. Like we said, maybe sub $1 million might actually hold up okay. Yeah. But then some of those more expensive, 1.5, 2 million above, where you've got a lot of pressure, not just from housing, but you've probably borrowed as much as you possibly could. You've got some kids in private school and all these other expenses. And I don't have any kids in private school at the moment, but I know those expenses aren't getting any cheaper at this point in time. I see clients go through it all the time. But, we were talking a little bit about this yesterday. And we're going to have a chat with our advice team tomorrow on this around, where does this leave property investment as a viable strategy? And, does that mean then property is completely off the cards at this point in time? I know we took a bit of time talking about it yesterday around, maybe you wouldn't go in as quickly as you would have in the past. There's a lot of other variables there. The big one I always talk about for clients with buying properties, your cash flow just needs to be on point. You need to be able to, you needed to be able to survive without relying on negative gearing. Was always my starting point, because so many people were always, their accountant told them to buy an investment property because they can save some taxes, is why a lot of people were going into property, but you don't get that generally to the end of the year, that tax refund. So your cash flow had to stack up throughout the year, and you want to make sure there's a good buffer there so you don't have to sell the property, I suppose, prematurely, because I've seen some clients actually do that who got caught in COVID, interest rates went down, they borrowed up to their limit because interest rates were so cheap, so borrowing capacities were higher at that point in time as well. The Reserve Bank was saying no interest rate rises for, was it like 3 or 4 years or whatever it may be? Yeah. It was like 7 or 8 months later they started, hiking interest rates. And I've personally seen a couple of clients that were just forced to sell homes in the last couple of years. They weren't able to maintain them. So where do you think, or if you're speaking to someone who's on the fence now around buying property, what are you thinking about here?
Well, it's interesting because again, like with investing, we always want to zoom out, right? If you just look at the last 10 or 15 years, it was hard to lose in property, right? If you bought an established house, like prices just kept rising. If you're investing in the stock market, it's all been about the tech sector and the S&P 500. And because of those two things, I think a lot of investors have forgotten that income and yield actually matters when you're making an investment decision. Because it's been so easy in those two sectors, it's been relatively easy just to go for capital growth. And you're getting so much growth, you don't care about the income or the rent or the yield. Yeah. Now we have to go back to basics because, especially with property, because if you have a very low yield, you don't have negative gearing tax benefits to help with your cash flow, and the capital gains aren't going to be as easy to come by. So you can't just blaze away and go around buying residential houses anymore and think that that's a winning strategy, in my opinion. Yeah. So we need to think a bit more carefully about this and look at other options. We've spoken about it. They haven't taken away self-managed super fund borrowing, so you can still buy properties and house that in your super fund. They haven't touched commercial property for negative gearing and so on. So there's other strategies that we need to look at, and the yield and the cash flow is more important than ever.
Yeah. And interestingly enough, we also heard from the broking team yesterday that some of the banks have actually started reducing interest rates on SMSF loans. So clearly they're a little bit worried around the uptake on SMSF borrowing. So they've actually started reducing some of the interest rates on it, which historically, I suppose, the interest rate on a self-managed super fund loan would be at least probably 0.5 or 1% what you're going to get on a standard property. So you're generally already paying over 7% on a SMSF investment loan. But yeah, the real winners, and I was doing a video over the weekend on this, was SMSF's unaffected, but I think so many more people are going to be looking at commercial property. And I was already seeing it in the headlines over the weekend. There was 7 news, 9 news doing all these various different interviews. So they're pouring a little bit of fuel on the market there, and even some of the buyers agents that we work with, I know, are starting to look a lot harder at commercial property. But the price range is generally going to be a little bit different as well. Like, we have a lot of clients that are generally buying investment properties probably sub $1 million most of the time. But then with commercial, you're probably looking at 1 to 1.3 plus as even a start
at least,
point.
Starting point
to even get going. So that's, I think it opens up more of those doors, but that means you're going to have a bigger deposit. Commercial property usually requires 30% deposit as well. You got to weigh up, vacancy, all the other variables that go associated with commercial property as well. But we definitely can't forget the old equity releasing going into shares, totally untouched at this point in time. I know we've touched on that in the last couple of weeks. I think a lot more clients will be considering that.
For sure, yeah. It's just that we spoke about it last week. Like, you're just going to have to be very aware of the tax settings, like the changes to CGT also apply to shares. Mm-hmm. You can negative gear, but it's going to, you really need to be careful with your investment strategy, because if you go after income-paying stocks to help with your cash flow, often those stocks are not the best. Like, you're not going to get the best total return in those sorts of shares, those sorts of companies.
Yeah.
So you need to tread carefully. But yeah, I think some people are just going to still go after resi property, and they're the ones who will probably rush to a self-managed fund or something. But if you're prepared to consider the broad scope of everything that's out there that you can invest in, you should be looking at commercial property, looking closer at the stock market. Because the old strategy of just negative gearing as hard as you can and buying houses is going to be tougher.
Yeah, no, well, I think a thought that comes to my mind for the right individuals, which is probably going to be the few, not the many, buying where there could be a bit of blood in the streets here, a bit of distress in the market. There could be some opportunity, I'm sure, in certain segments of the market around Australia. And if you've got big cash buffers, you get negative gearing didn't really mean anything for you anyway. To begin with, it was kind of a nice little bonus that you got. And you've got a long-term outlook, which would be, say, 8 or 10 years plus. My view, I wouldn't be opposed to, still looking at property, but a lot of other factors have to be stacking up more than ever. But I'm sure there's going to be people thinking, great, this is a great time to think about maybe buying in the next 6 or 12 months. We were even chatting in some of the blue chip suburbs like Q East and so on. You might see a bit of pricing pressure there, and then possibly for some people, it might be a really good time to get in the market if you've got a long-term outlook. And another thing I would also add for a lot of young people and getting in, I think sometimes getting into property, like it forces you to save more as well. Like, it gives you the responsibility. You have a loan repayment. You have to basically pay that, or you're going to end up losing the home. So I think for the most part, there's a lot of other factors that I think sometimes get missed, because it's like, oh, do I buy property or just save my money? But there's more chance if you're just saving money, you're just going to end up spending it. Whereas if you've got your own home and you're forced to meet those mortgage repayments and you've got to grow up, I think there's something to be said in that. And I think that was something that was really key for me when I moved out of home at 21, was like forced me to grow up pretty quick. And got to start paying some bills here and all these other variables now and meet some mortgage repayments. So I'm still naturally a fan of property really long term, but I think shorter term here is going to be a bit of rockiness in the market. You
need a long-term view, because if you're looking to invest in a resi property, if it's in an area that's going to have very strong first homeowner demand, then you could still do well, because at the end of the journey, when you go to sell it down the track, you might be selling it to a family, right? And it's in demand. Whereas if you're in a sort of investor hotspot, that's where you might struggle.
Yeah.
And then the other thing to think about is with these tax changes, because for capital gains tax, yes, you don't get the discount. But if you're investing super long term, your cost base is indexed, right? So if the growth in your property sits at around inflation or just above inflation, you're actually not going to have a big tax bill at the end.
Yeah.
And then all your negative gearing benefits are gone, but those cash flow losses, you still carry them forward. You still get to use them. So zooming out on a long time frame, the tax situation isn't bad at all. It's really just that when you first buy the property, getting those net gearing benefits helps your cash flow. So as long as you're able to wear that, there's still opportunities.
You know, I've seen various accountants come out in the last couple of weeks showing various examples of where it's pretty much not much difference in terms of you hold for 10 years and then you look at selling. So, yeah, I think there's more to dive into there. If we change pace and we go over into the banks, we're calling a banking bubble.
Yeah.
Do you want to unpack a little bit of some of the digging you've been doing here, Billy?
Yeah, so let's talk about the bank bubble. So I've been right into this for the last year or two in particular, because I never liked the big four banks in Australia as an investor. They look extremely expensive compared to other similar banks globally. And one of the best examples is JP Morgan. So that's the world's most profitable bank. That's trading at 13 times earnings. So the PE ratio, that's how it's valued. CBA, Commonwealth Bank in Australia, is trading at 26 times earnings.
Wow.
So it's literally twice as expensive as JP Morgan and arguably a lower quality bank. Or let's say equivalent quality maybe to JP Morgan. So, but it's twice as expensive. It's essentially like a tech sort of multiple. Like if you buy something at 26 times earnings, you're expecting a high rate of growth.
Yeah.
Commonwealth Bank's growing their profits at 3 to 5% a year. And this year they're going to struggle with that growth. So very expensive. And the problem is that makes up a big chunk of our share market. So even if you buy an index fund, you're stuck with the big four banks in there. And I don't think they make a very good case for investment.
And well, that PE ratio, I don't know if you have handy, but like the CBA has always been the standout. And you probably leave Macquarie off to the side. It's a bit different than the big four. Where are the other banks sitting relative?
They're sitting at 18.
Okay.
So CBA is 26, the others are 18. CBA's managed to grow their profits. Like they've been it's a better bank to invest in than those other banks. The problem is it's just priced in. Like it's just really expensive.
Yeah.
And your dividend yield isn't high anymore. Like that used to pay a dividend yield of 6% plus franking credits. Last I checked, I think it was down to 3.
Yeah. And
so you're getting a better yield in a savings account.
Yeah. I mean, I suppose that would have an effect of like the actual price, the actual growth rate of the actual bank over itself over the last couple of years has shot up. I think it touched over 200. It did at one point. It's come off a fair bit.
I don't know if it touched 200. It definitely pushed through 190.
And
then a few weeks ago, it dropped 10% in a day after the net gearing announcement.
Yeah.
It's now down to $160. Yeah, so on this topic, I want to call out a guy here, Charlie Atkin. He's a stockbroker / fund manager in Sydney. He sends a weekly newsletter. I've been reading it for years and years and years. Like all stockbrokers, sometimes he gets it right, sometimes he gets it wrong. But he has been screaming about CBA being expensive for the last couple of years. And I reckon it was just over a year ago, he said, you're mad not to dump CBA and buy BHP. In the last 12 months, the performance differential is 70%.
Wow.
So CBA is down 7% over 12 months. BHP is up 63%.
Huge.
To be clear, I'm not telling everyone to go sell CBA and buy BHP.
Yeah.
But the point is, sitting on bank stocks, there's probably better options. And now with the tax changes, higher rates, all that stuff, now I'd be really, if you've got a big CBA holding, I'd be seriously looking at it and questioning whether you should sit on that holding or diversify out of it.
Yeah. So, pretty much every Australian has, got their superannuation fund's got some CBA sitting in there. But, I think we touched on it in the last podcast. The Australian index is so heavily weighted towards the banks and the underlying miners, which is quite interesting. And then if we talk about another point that you mentioned around 370 billion of lazy deposits at near zero. So you've been doing some digging here on banks. What have you dug up there?
Yeah, this was a good headline in the AFR. Yeah. Banks sitting on $370 billion of lazy money. What that means is the big four banks, this is another way they're trying to squeeze out more profits. If you hold just their main flagship transaction account, they won't pay you interest, or they might pay 0.1%, 0.5%. A few years ago at low rates, when we were at really, really low rates, that wasn't a big deal. Now it is a big deal because you can earn 5% in a savings account. So there is $370 billion of our money sitting in these accounts earning nothing. And in this article, they looked at, okay, what if those big banks were forced to pay you interest on all that money, like pay you 4%, 5%? It would eat into a third of their profits if they did that.
Significant.
So they're not going to do it.
Yeah.
They're not going to do it. You need to move your money, basically.
Yep.
AMP, Bankwest, Macquarie, they're all paying 5%.
And with those three, because I think one of the key things as well is a lot of those accounts or the high interest savers, they get you with like the honeymoon rate, the bonus interest rate. It's probably the most common mistake I see clients make is having, I've got how many clients that first come through to me, once they're working with me, they're not a part of the 370 billion because we've actually made sure they get it in a high interest saver. But God, how many times do you see people, they're in their regular transaction account, they're getting absolutely nothing on it whatsoever. But I think, the key thing we'll look out for there is a lot of those high interest savers. Of those three, I know Macquarie is always a standout because you pretty much don't have to jump through any hoops. You don't have to saw off your arm or go, whatever it may be, jump through some hoops to get that interest rate. It's just pretty much a straight high interest saver. Are those other two that you're referring to, are they similar to that of Macquarie?
I'm not sure. I know AMP is very competitive. Macquarie is always the best because they've been consistently paying a high rate.
Yeah.
And just worth noting, like people are cottoning onto this, Macquarie grew their deposits by 25% in the last 12 months. So they are starting to grab some of that 370 billion. And I checked their website today and they put the rate up again. So it's at a flat 5% now and a bonus rate of 5.35.
Yeah.
No strings attached, no fees.
Yeah. You can't really beat that for just some lazy capital sitting there on the sidelines. But the amount of people you see with that transaction account, which is where all their money is generally sitting, it genuinely blows my mind. It's key to understand that, like, people, when you're depositing your money into the bank, what the bank's then doing with that, say, 370 billion, is they're lending it out to everyone with mortgages and then making a nice difference basically on that. Well, they do also borrow money from the Reserve Bank as well, but they're taking a pretty steep clip.
Well, that's a good point, because if more and more people cotton on to that and that 370 bill starts shrinking, that will affect how competitive those big banks can be with their home loan rates, or it'll eat into their profit margin. So they're playing a dangerous game there. Yeah. And so that's when you look at CBA at 26 times earnings, go, okay, how are they going to grow their profit in a meaningful way, given all the headwinds, higher rates, they're paying no interest on all these deposits. Investors are being, taken out of the market to a degree because of negative gearing. So they're going to find it tougher, I think, unless they're really good at rolling out AI.
Yeah. Well, I have seen some headlines about them doing that, but I was even thinking of what could be an even worse combination for them is, of that 370 billion, how many people there do you think have got a mortgage? Like, maybe half? I don't know. Like, say we just guess as half of those people have got a mortgage, but they don't then have that money either sitting in their loan or an offset account. They've got it in those transaction accounts, not really doing anything. A worse combination there for the banks is if they don't even put it in the high interest savers, is if they start putting it in their mortgage offset accounts, which are paying a rate of interest of, say, 6%, thereabouts. And then that's offsetting interest on the loan, and then the amount of interest the banks are recouping is even less. So that even might be the worst case scenario for our big banks if that 370 billion got active, and for those that have got mortgages started getting a bit more smarter with their money.
100%. And do you want me to go through these numbers here on what you could do aside from just sitting in a bank account earning 0.1%?
Yeah, what have we got?
All right, so anyone listening, and you also might be thinking, oh, my parents have got cash, right? Because it's usually the older generations that are going to be sitting on a large amount of cash. All right, so if you're sitting with a big four and you have $500,000 sitting there earning 0.5%, in 10 years' time, with that interest building up, you're going to have $525,000. Obviously less than inflation. So you've got less than what you started with.
I'm not excited yet, Billy.
If you switch that to a high interest savings account and earn 5%, in 10 years' time, you've got $814,000, right? So that's an extra $300K.
I'm interested.
Not factoring in tax, right? Because that's just, they'll overcomplicate things. Right, so let's keep moving up the spectrum here. So fixed income, you'll earn roughly at the moment 6.5%. That means in 10 years we'll have $940,000. Private credit, which we've been doing a ton of work in over the last year, private credit will earn you a higher return than fixed income. If we assume 7.5%, that now gets you to $1 million in 10 years. Aussie shares, 1.2 million. US shares, 1.6 million. So sitting there in those big four transaction accounts is not the winning strategy. You got to take some action here.
You're basically supporting our banks in their efforts to.
Yeah, you're helping them with their profit. If you like doing that, you feel good about that, that's fine. But I haven't met anyone yet who would agree with that.
No, I don't think so. No, it's really interesting. Obviously, we're not even factoring inflation in that, because really for your first example of getting your 0.25, say inflation's running between 2 or 3% over that 10-year period of time, you've actually gone backwards on a real basis on your money. Inflation has just eroded away that. So at a bare minimum, you're going to be looking at those high interest rates.
And again, we're not factoring in tax. So firstly is, where should the money go? It shouldn't stay in that account. Then secondly, what's the ownership structure and the tax situation? Because you have control over these things, and the government haven't touched super. Yeah. Right? So if you're in your 50s or 60s and you're sitting on cash, that'd be the first thing you'd be looking at. Getting in super and invested, it's a massive difference.
Yeah, that after-tax basis return is so important, because 5% headline interest rate sounds amazing, but then when you're in the highest tax bracket and you lose 47% of it, you're getting down at 2.75-ish in terms of what your return is on that sort of basis. And it's key to understand for those the latter examples that you're mentioning there, the Australian share market, US shares, predominantly there you're going to be getting capital growth, which is untaxed. You're not paying any tax for the most part on that capital growth, unless you've got some realized gains within the funds that you are using. So although you're going to still have some income generated from those types of investments, more so in Australia, which would typically pay a higher dividend than that of what you would see in the US, a lot of the gain that you're getting there is pretty much untaxed over the 10-year period of time. Whereas all of your earlier examples, like private credit or the bond market, paying you a steady coupon, or called like a dividend or passive income, your high interest saver, you got to take away tax on all of those, and that's going to erode pretty much half your return if you're in the highest tax bracket.
Yeah, spot on. So I mean, this is a whole nother podcast, but that's why a diversified portfolio. So not saying anyone whack it all in the S&P 500.
Yeah, and you could, like, I've seen scenarios where you've got retirees sitting on a pretty large amount of money. They've got investments, properties and other assets outside of superannuation. And that is then meaning, even though they're not earning any income from employed income or their business, they've got enough income from those investments that it's pushing them into tax bracket territory. Like, they're actually still paying taxes on all of their investment income, but then they have taken advantage of how much money they can have in superannuation, which is going up from July 1st as well, mind you. And if we're comparing those scenarios, let's just say part of their portfolio, they still want to keep it defensive, which we always do, want to have some of it defensive at that point. They could put it in a high interest saver outside super, which is generating the 5%. But let's just say they're taxed about a third on that because of the amount of income that they're generating. Whereas they could just put it in like a term deposit through their superannuation, because a lot of good superannuation funds these days do have a broad investment menu where you can nearly invest in anything you like these days. And so in the superannuation example, depending upon what your balance would be, you could do the same thing, but then not be taxed on any of the interest generated on that term deposit. Whereas in your own name, if you've got a lot of investments in your name, you would still be then taxed on it if you're over age 60. So and then we're not even getting into the weeds of investment bonds. You could look at doing a similar thing through investment bonds and investing in some of those more conservative investment options, which then do improve your after-tax returns. I think there's a lot in there to consider.
A lot, yeah, absolutely.
So I suppose in closing, Billy, we've covered a lot off today. What are some of the big key takeaways for people that are listening?
Yeah, three big ones. So on property, essentially the maths has changed dramatically. Your borrowing capacity might have changed. The sort of property you'd want to buy has potentially changed. And for some people, it means just not blazing away and borrowing money and buying a property right now. Mm-hmm. For others, it means you really need to pivot on your strategy, on what you're buying, what ownership structure, etc. That's on property. Then we've got on the banks, if you're sitting on a bunch of CBA shares, it's often an inheritance. By the way, that's what we usually see. If someone has a huge CBA holding, they've usually inherited it from somewhere, or they bought it back in the 90s or whatever. Sitting on a big CBA holding, a lot of people sit on it because they're scared of paying CGT, but I would prefer to pay some CGT rather than sit on an investment that's not going to give me a good return.
Agree.
So you need to weigh that up. And then the last one is sitting in those crappy transaction accounts where the big four are just using you to boost their profit margin. You need to get the money out of those accounts.
Yeah, you're basically layering the bank's pockets at that time if you're in one of those transaction accounts. I can guarantee there are people listening that are one of those. I'm sure we've all been one of those people at some point in time until we actually got smart about our money. And yeah, I suppose the only things I would add is I think the key theme around all of what's happened lately in the budget announcements is, no knee-jerk reactions. Nothing has been legislated at this point in time, although it looks like a lot of it will be legislated. But I think, and not that we've spoken about it today, I still think the government might water down some of the things they've gone at here for business owners, and because they've just whacked tax on, saying that they're doing it for the property market and helping first home buyers and so on and so forth. But then at the same time, they've just whacked everyone, not just property investors. They've hit business owners and the alike. And I'm still seeing a lot of attention around that online and a lot of steam behind it. So it's going to be very interesting to see where that one lands. But yeah, with property, like I again, still a fan. I think, definitely look a lot closer at the numbers. There could be some opportunity for the right people in the right situation over the next 6 to 12 months, but I don't think you should be blindly rushing into the property acquisition. Looking at the structures of what you own it in, commercial, definitely on the radar for the right people. So if you're sitting on maybe 200 to 400 plus thousand of cash, or you've got equity that you might be able to release and look at acquiring a commercial property, maybe that could start making sense. But, a whole different discussion to look at there in terms of your goals, your investment time horizon, and then your buffers. And then, I think the key thing, who hasn't seen a retiree with CBA shares that they've inherited or they bought for whatever reason? I can't tell you how many people I've seen like that. And I think there is sometimes a bit of emotion that is behind some of those investments. And that's a key thing that a good advisor is going to help you sort of work through. Is having an emotional attachment to any investment's not a good idea.
No.
Put your family home aside, because that's a totally different purchase, a lifestyle purchase. But how many people would we see that have just got it because for the sake of it, or they inherited it from their grandma, and there is that emotional sort of attachment and baggage there, and then that is the biggest kind of opportunity cost that they're missing out of just maybe selling, realizing a bit of CGT or capital gains, and then deploying that money elsewhere. It's kind of like the whole sunk cost fallacy, where people, we seen, they buy assets and they just hold it because they're just invested emotionally and don't want to cut ties with it. Sometimes that can be some of the best decisions that you could be making, and then deploying that money into something that's a bit more active and working harder for you into the future. So I think we've covered a lot off today. Billy, any final remarks?
No, we're good, mate, and I'll look forward to next week.
Cool. See you next time, guys.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.